Hello, everybody, and welcome to our class. Today, we're going to talk about short put strategy. What does that mean? Shorting puts, how it behaves, how can we make money from it, which direction do we need, and what are the key parameters that we need to know before we are entering this kind of strategy. So let's start before we begin. All right. So what is a short put? The official explanation for this is with the short put option strategy, the investor is betting that the stock will rise or stay flat until the option expires. If the put option expires worthless or out of the money above the strike price, then the trader keeps the entire premium, which represents their maximum profit on the trade. In other words, you want the stock or the underlying to go up. Let's see some key factors before we enter the example. I want to show you that in our previous lesson, we saw the buying of the put option. Now we're going to see the other side of the option buyer. That's the one who sells the obligation. Remember that we are writing a put position, and we need to know some key elements here, right? So writing an option is a new creation of obligation in the market. We're making a new interest position in which the seller is obliged to buy the underlying at a given price at any time. That means that if we are selling the put option and we are committed to buy it at this specific price, then that means that we're obliged to buy it depending on the buyer's option, whether he wants to exercise it or not. That depends on him, but we are obliged to buy it from him. Any naked writing of option demands securities in the form of margin calls. Be aware that there is some sort of payment for this in the form of securities. That means that the bank or your broker is going to take some amount of money and it's going to put it aside, and this is for the sake of basically him, the bank securities. He won't be happy to pay for your losses, so that's why you need to put some securities inside. The cash premium is given straight to the seller, and he cannot make any more profit from the trade. That means that whatever you got when you sold this option, that's it. You won't get any more money and or make any more profit out of it. So you're getting money, you're selling an obligation. The key element here is how much money you're going to give back, or if at all. Remember that also the time effect, the theta values at the seller's side as part of his risk valuation. Well, that's a good thing for us as sellers. If the underlying does not move every day that goes by, and the option is going to lose some of its value, it calls the theta. I'm going to see it later. And it's time effect. And remember that the option price is always built from intrinsic value and time value. And if time goes by, nothing happens, you make money. Remember also, this is really a warning, guys. This means that your loss potential is nearly endless. You can suffer tremendous losses if you're doing this strategy naked without any protection in the form of hedging the strategy. But theoretically, your potential loss could be endless. Why nearly? Because a stock can drop only all the way down to zero. Okay, and the seller of this option is taking the upside. Of course, you have to be bullish. That's the only thing you want in your life right now, is that this stock or this underlying will rise and rise as much as he can. This short position, remember, can be closed at any trading time. That means that you can close this position after a minute or after an hour, a week, or a month, depending on how long the option stays alive in the trade. And if you're buying the same option that you have written, then that means you have no more obligations since you sold one and bought one. So that means that you're zero in obligations in the market. Okay, so let's see in a short example. Let's say there is a stock which is priced right now at $100. There is put 100, which is sold in the market for $2. Just for the example, we'll say the multiplier is 1, and there are 30 days till expiration, and there are no commission fees. So let's see this short put cash flow, how it's going to look in this graph, and what is going to be our cash flow. So we're going to build three scenarios. Excuse me. First one, we're going to see if the market goes down, if the market stays in place, and if it rises. So let's start with the worst case scenario for us. That means that we sold one put 100 for $2, and after 30 days at the expiration, the stock lost a lot of momentum and really crashed hard, went down to 80. So let's see the cash flow. So you see the revenue, we got $2 for selling this option. The expiration value of this option is for the buyer, it's $20, and for you as a seller is minus $20. So if you're going to see the cash flow here, it's 100 minus 80. Well, that's the expiration value, minus 20 for you. Okay, and you got just $2 more, then that means that you lost all in all $18. Okay, I know it should be minus here, but my mistake, my bad. But remember that for you as a seller, expiration in 80, that means that you lost $20, but you only got $2 back. So it goes the same at 90. This time you lost just a little bit less because the expiration value is minus 10, and you still got your $2 revenue from selling this option. Then that means that your total loss is going to be minus 8. Let's see what's happened in 98. Let's say the expiration wasn't so bad. The market just fell 2% and expired at 98. So you got $2. The expiration value is minus 2, and you got $2 for it. Then you went down to 0 net value. Nothing happened. You didn't lose. The buyer didn't lose. And that's it. That means that this is your break-even point here at 98. That means that any expiration below 98 is gonna the consequences of it is gonna be losing money. So you see, any expiration below 98 is loss. Let's see what happens at 100. Excuse me. If the stock expires at 100, that means nothing happened in the market and the stock didn't rise and didn't fall. So you still got your $2 revenue for selling this short put. And that means that all in all, your net profit is $2. And it so goes the same from every point from 100 and above going up. You're going to make $2 for sure. That's it. Expiration at 120, you got net profit of $2. Again, reminding you, when you're shorting this put strategy, that means that you're going long and you strongly believe that the market's going to rise. Okay, so now let's see some real examples. I'm really liking this this 3 examples, and I want to show you that there is also something interesting, and that is the time effect. the implied volatility effect, and it's all been calculated to our risk premium. So in this example, I want to show you TD Bank. It's Toronto Bank in Canada, which has a significantly pretty low implied volatility inside himself. He's pretty stable. That's a pretty stable stock and doesn't tend to fluctuate too much. So it affects his implied volatility. As you can see here in this is the implied volatility side. You can see that the stock is being traded now at 73. That means that the implied volatility is around a little bit less than 20%. Considered short, pretty short. So if we're looking at this option chain, and we can see that there are 27 days till expiration, then, and we're thinking, yeah, sure, why not? The stock is gonna rise, nothing gonna happen. Feeling pretty confident. We're going to the market and we want to sell one put because we believe the market is going to go up. So you can see here the stock has been, this option has been traded between 1.1 and 1.25. And let's have a demo and see how much we're going to get. So we said that, let's say we're sold it for $1.25. And this is our expiration graph looks like. This is how it looks like. As you can see, the stock has been traded here at 73. We sold the 72.5 option, put option. There is no 73 put options here. So this is the closest one to the strike. And we're getting $1.25 multiplied by 100 as usual. So our entire revenue is $125. As you can see, our margin request is going to be $1,500 for opening this position. And we're getting $150. That means that from this point, from 72.5, we're going to have to go down $1.25, and we're going to make it at this point at 71.25. This is going to be our break-even point. And from this point downwards, we're going to lose money. For every $1 that the underlying the stock is going to lose, we're going to lose $100. And what can I say, guys? It goes from bad to worse, from bad to worse. The lower it gets, the more you're going to suffer losses. Okay? I can say that it doesn't look too well, because if it rises, it's still going to make just $150. That's it, even less. $125. That's all you're going to get. And you lie down $1,500 for getting $125. I can't say it's a good gamble. So you can see here, it's pretty short, and I don't like it. But let's take a different stock which has a greater implied volatility inside her. Well, let's look at this stock. It's called Lemonade. Excuse me. Again, as you can see, this stock has an implied volatility of at least 71%. The stock has been really volatile lately, as we saw it in the previous lessons. Maybe as you can see here, the stock reached almost $200 just in the beginning of the year. And then it fell and crashed down all the way to 80 something. And then it tried to rise up to 100 back again, and then fell back again to 50. Now it's trying to make its way back to 80. You see it's fluctuating, and all the time it rises and falls, rises and falls. All these movements in the market really increases the implied volatility of the option. And that's why it also affects the price that the sellers would ask for selling you an option for this stock. It goes both ways, both for the calls and both for the puts. Because some traders, the logic says, some traders might think, oh gosh, this stock is crushing and it's always going down now. So let's buy puts because it's going down. That makes sense. And they're increasing their demand for put options. Now the sellers are not stupid. They see what's going on. And they're saying, listen, the stock has crushed significantly, more than 50% in just a few months. Then I'm not going to take my chances and give you money. I want higher premium. So that's why they're asking for more. Besides the fact that the spreads between the bid and the ask, the bidding goes up because the asking is way greater than the bidding themselves. And that's why you get a higher price all the time for the puts. And that's what increases all the time the implied volatility of those put options outside the money. But on the other hand, when you look at the calls, and some investors might think, geez, it went so bad. It lost more than 50%. Now it's the time to buy the stock. Let's buy some calls because, come on, the stock is going to recover and going to go back again, and we're going to make profit. So they're increasing their demand also for the call side. And the sellers also see that, and they're also asking for a greater premium. So you see, this is a short example for why implied volatility affects so much options price. All right, so let's give an example. As you can see, the stock has been traded now at 78, something like that, on nearly 80. And look at this, on this side puts, you can see that the stock, which is traded pretty much at the same price as TD Bank that we saw previously, you can see that you can get $7, at least $7 for selling put 80 in the market. So let's see how it looks if we're going to sell one short put on 80. Going to analyze, sell trade, single. And excuse me about that. And let's say that we got now $7, okay? We sold put 80 for $7. And that means that we got $7 till the underlying goes down. As you can see, it's going to reach 73. And that's, I think it's way better than the $1.25 that we got on TD Bank, right? That means that if we're selling this, we're getting $7 over 80, and it's 9% or something like that. A little bit more, excuse me, 11% from the strike. That means that the stock can fall, excuse me, I don't know math, 9%. It can fall almost 10% from 80, and we're gonna still gonna be close to the market. It's gonna fall 9 or 8. So you got here a bigger spread, better spread than this put option that we got only $1.25 from it. On the other hand, we got $700. That means that this is going to be our entire profit if the stock rises, and we're going to make some big money. Now, so you can see if you're going to sell short put, try to find a stock that has already went down pretty hard for several days or for a long period of time now, and you can see that it has pretty good chances of rising back again. And if you're going to see, like in the chart, you can see here that once it fell to this low around 80, when it has been traded, at around 80 something, then at this point that was could have been a good decision to sell the put, because you got it right in time and you said, yeah, from this point on the stock is going to rise, and yeah, this short put is going to make some money. But on the other hand, you can see that afterwards The stock even went down even greater, and it's truly gambling. It's truly gambling. In our next lessons, we're going to see how we can evolve this strategy with other strategies, and we can see that that could be a pretty good strategy when we add some other strategies into it. But this is going to be, we're going to tell you all about it in the next lessons. So one last example, I want to show you even greater twister, implied volatility, stock. You can see stock has been traded 95 now, but implied volatility is even greater. It goes around 85, almost 90% implied volatility in the options. And you can see that we can get here. The last trade was at 8, and 8 is better than 7. And if we're gonna sell the same option at higher levels, let's say we got $8, then that means that from 95 we got $8 that brought us to 87 break-even point. If we were gotten $10, then it would have brought us to 85. As you can see, the more revenue, the more payment you get from the stock, that from selling the option, you're going to get a greater and wider break-even point from the strike. So take in mind that this is a key factor when you're selling short puts. Generally speaking, if I want to, if you ask me, you probably could have, I guessed that I'm not in favor for this strategy. If you're doing it naked, so be prepared to suffer losses. I mean, it can work for a while and for several trades, it can work well, but once it goes down, it's going to slam your face pretty hard. We saw it in 2008. We saw it now with the coronavirus crisis around the world, global. And when it falls, it can fall really hard, really fast, and you can suffer significant losses. And my advice to you is never to do that naked. I mean, if you're going to do it, then at least hedge yourself and buy one put out of the money. If you're just for the example, let's say we got $8 for this, very volatile option. So let's say we got $8 that brought us exactly to 87. This is our break-even point. My advice, if the stock is going to continue and crash and you don't want to lose like $2,000, then just buy put out of the money. Let's say we bought put 75, okay, and we're gonna pay for it just $1, and then you can see that we at least caught our losses to 1,200, a little bit less than $1,200, and we're not losing $2,000, which is better, but still not amazing. Of course, take in mind that if you're hedging yourself in this kind of strategy, then take in mind that if the market does go up, you're going to earn just $700. That's because you spent $100 from the $800 you got as revenue from selling. You spend $100 for hedging. So that means that if the stock is going to rise or stay, you're going to make $700 and not $800. More games, more strategies, more interesting strategies is going to come pretty soon in our next lessons. But in this lesson, I wanted just to show you the basics of short put naked and pretty much saying to you, don't do it without any protection. Always hedge yourself. All right, guys, that's it for now. Hope you enjoyed it. See you in the next lesson. And may all of us have good luck. Goodbye.